The consumer staples sector ranks first in our second quarter 2014 series on the best and worst ETFs and mutual funds by sector. As you can see in figure 1, my top rated ETF is Vanguard Consumer Staples ETF, ticker VVC. My worst rated ETF is PowerShares S&P Small Cap Consumer Staples Portfolio, ticker PSCC. My top rated mutual fund, as you can see in figure 2, is the Vanguard World Funds Consumer Staples Index Fund, ticker VCSAX. And my worst rated mutual fund in the consumer staples sector is the Fidelity Select Portfolios Construction and Housing Portfolio, ticker FSHOX. Figure 3 is one of my favorite figures in all these reports because it breaks down exactly how many stocks get a good rating against how many ETFs and mutual funds get good ratings. So you can really see whether or not the ETF providers and the mutual fund managers are allocating capital to the best stocks. In a lot of cases, what we see is there are plenty of good stocks, plenty of good large cap stocks for mutual funds and ETFs to allocate to, but they do not. Fortunately, the reason consumer staples is ranked number 1, they do a better job than most sectors. My favorite stock in the sector is Colgate-Palmolive, ticker CL. I love this stock because it's got a strong track record of profit growth, 7% compounded annually over the past decade. It also earns a top quintile return on invested capital, something we always like. And yet the stock is cheap. It's trading at $64, but it's worth $84 if the company can simply grow NOPAT at even a lower rate than it has in the past, say 6%, for about 15 more years. This is good risk reward and a stock you should buy. My worst stock in the sector, my least favorite stock, is Dunkin' Donuts, ticker DNKN. We recently wrote a story on why we believe this business model is not going to work. First of all, in the parts of the world where they've got great franchises in the East Coast, Eastern Seaboard, they still don't have a very profitable business. The returns on invested capital are half of what McDonald's are, a third of where Starbucks is, and yet they're planning to expand out through the rest of the country into where these great competitors, McDonald's and Starbucks, already have strong competitive position. Not going to happen. The business expansion is going to probably result in a lot of write-offs, a lot of shareholder value destruction, and a price that's going to go way down. The current price is way too expensive anyway. To justify $50 a share, the company needs to grow its profits by 50% compounded annually for 12 years. That's a big number. Expectations too high. Bad risk reward. Sell this stock. Figures 4 and 5 also highlight exactly the landscape, what we call the landscape for ETFs and mutual funds, showing you exactly how this sector, consumer staples, does in terms of the number of funds and the amount of capital allocated across our rating spectrum. Very attractive, neutral, dangerous, and very dangerous.